What is going on, guys? Today we're going to be talking about why I owe Robinhood $45,000 and why selling credit spreads and iron condors is what led up to this. Now, really, we're just going to be talking about exercising and assigning contracts because in reality, I don't owe Robinhood $45,000. That would be actually crazy because it was literally only like a $100 play. So if I owed Robinhood $45,000 from $100 play, that would be actually insane. So we're just going to talk a little bit about exercising and assigning because I talk about exercising and assigning contracts a lot in all my other videos, but I've never made videos specifically about exercising and assigning contracts. So I just want to go a little more in depth into those, and I'll probably make two separate videos as well, one on exercising and one on assigning. I just wanted to get this little clickbait why I owe Robinhood $45,000. So let's get right into what assignment and exercising options contracts are. It's really simple, so don't try to overcomplicate it. So all exercising an options contract is when you're making the seller fulfill the contract's agreement. So on a call, it's the right to buy 100 shares, and if it's a put, it's the right to sell 100 shares. And that's for exercising because you're buying the options contract that says you're able to buy Home Depot at 227.5. If the contract goes in the money, you're able to exercise it and buy these contracts and then sell them at the price wherever it may be. It says Home Depot's expiration price was 231.91. So if you didn't have another contract that you sold, you'd be able to exercise this, get the HD stocks at 227.5 each share. An options contract is 100 of those shares, so 100 times 227.5 is 22,750, but you'd be able to sell it at the price that it's currently at, or you could hold them, whatever you wanted to do. And then on a put, you would be selling the shares at 100 because calls and puts are the opposite. When you have to exercise a put, you sell the shares. When you exercise a call, you buy the shares. Because if you have to exercise a put, that means the stock went down and your put went in the money. So that means you want to sell the shares at a higher price than the stock is currently at because you don't want to sell them down there, you know? If the stock's trading at, say, Home Depot's trading at 220, you don't want to buy them at 227 if you have a put and then sell them at 220. That wouldn't make sense. So that's all exercising is. I hope that made sense, but let's get into assignment then. When you're assigning a call, that means you're selling the 100 shares. So I bought these shares at 227.5 because I had a call credit spread. But now, since I got these at 227.5, I have to sell them to someone at 225. Whoever bought this 225 contract, they exercised me. Now I have to sell the 100 Home Depot stocks that I bought at 227. I have to turn around and sell them for 225 to someone else. So that's just kind of how assignment and exercise relate. But as I say in every video, calls and puts are the exact opposite of each other. So when you get assigned on a put, you have to buy the 100 shares. So if Home Depot was trading at 220, you would have to buy the shares at 225. You wouldn't be able to sell them for lower because Home Depot would be trading at 220. I hope that makes sense because I don't have a put credit spread I got assigned on that I can show you guys. All I have is this call one, so I hope that makes sense. But maybe we can go into like a chain and help you guys make a little more sense of it. I feel like Tesla's a nice volatile stock for this, and it's trading at about 500, so it should be a lot easier to explain. So Tesla's trading at 504 right now. If I had sold this 502 and bought this 505, and that would be a call credit spread right there. This 502.5 would be in the money, so I could essentially get assigned on that and have to sell someone the shares at 502.5. But luckily the share price is 504, so I wouldn't have to exercise the 505. I could just buy the 100 shares at 504 and then sell them to someone at 502.5. And Robinhood will just let you do this. You don't have to have thousands and thousands of dollars to do these spreads. As long as you cover your contract you're selling, you're going to be able to make this trade so long as you have the collateral in your account. So you might need a few $100s, but you're not going to need $50,000 to buy the 100 shares of Tesla. So in this scenario, we'd actually probably make money because we're buying the shares at a little bit lower price than where we said the stock was going to go. But if, say, we got the 500, we sold the 500 and we bought the 502.5, we would get assigned on this 500. We'd have to sell the 100 shares at 500, but the stock's trading at 504, so we don't want to buy 100 shares at 504. We'd want to buy them at 502.5, so we would exercise this contract we bought, buy them at 502.5, then sell them at 500, and then we wouldn't lose as much money as if we had to buy them at 504. And then on the put side, if we sold this 507.5 and bought the 505, we would get assigned on the 507.5, and we'd have to buy the shares at 507.5 because this is a put credit spread. This isn't a call credit spread. And then we would exercise the 505 so we could sell them at 505 rather than 504. And that's just the basics of exercise and assignment. Of course, the break even has a lot to do with it because that decreases and could increase as well your chances of hitting one of these contracts, because if it goes to your break even, maybe you won't get assigned because sometimes they don't assign the contract. But even if they did, you'd be at your break even, so you wouldn't lose any money. So I hope this helps, gives a little visual representation of how you would get assigned and exercise a contract on the call and the put side. But if you do get assigned, just know you don't owe Robinhood $45,000 or whatever the stock is trading at. That's just them margin calling your account, trying to clear everything up with their system. So this should be cleared in a day or two. Hopefully it gets cleared before the market opens. Sometimes you have to wait a whole market day before it even gets cleared, but you can also email Robinhood and make sure they're actually clearing it. So you gotta be patient and wait and not freak out because you don't owe Robinhood that much money. If you did owe Robinhood that much money off a $100 play, that would be actually insane. So yeah, don't worry about that. I hope you guys enjoyed this video. Be sure to leave a like, comment, subscribe. Be sure to check us out live. We're live Monday through Friday, market open to market close. And I'll see you guys in the next video.